planning and investing in alpha strategies. Neil Winward, seated next to him, founder and CEO of Dakota Ridge Capital, where he helps family offices make tax advantage investments in the energy space. Elliot Trexler on the screen to the right is the Chief Investment Officer at Global Return Asset Management, where he manages an equity long short strategy and value stocks.
Past, it was scored at providing around 369 billion of those tax benefits over a 10-year period. Now, that was somewhat of a subterfuge because there is no cap on those benefits. If you build projects, credits will be made available subject to the US government having the cash back to do so, right? But there is no limit. So that 369 billion is expected to expand, and Goldman Sachs thinks it'll be 1.2 trillion over the next 10 years. Others think more. It's an enormous injection of government sort of thumb on the scale into the economy. And I think the other thing to bear in mind is it is somewhat technology neutral. The credits are available for nuclear. They're available for carbon capture and storage, which is capturing the emissions from fossil fuel facilities and transmitting and storing those underground. That earns tax credits. So there's a huge push around energy. I think the stimulus that's providing to the economy is paired to the reshoring that's going on, because the CHIPS Act creates incentives for factories to be located here. The Inflation Reduction Act creates incentives for the production of domestically manufactured equipment that is manufactured in those factories. So the amount of stimulus is huge. My only concern about it is whether we will have the tax revenues to pay for it.
Got it. Thank you, Neil. Okay, we're going to turn to Tyson. Tyson, in your ESG business, have you noticed any slowing from energy companies in their ESG planning over the past several years? And how does the outlook for ESG look under a Trump versus a Harris presidency?
Well, I'll take the last part first. I think that ESG has been in decline. I think that basically the idea that we could displace fossil fuels with solar and wind has been shown to be ill-conceived and physically impossible. The numbers simply don't add up. And we need an all of the above strategy involving nuclear, but also fossil fuels and hydrogen and the like. And I think that historically, you've had a much stronger interest in supporting ESG strategies, such as the Inflation Reduction Act, which really should have been called more of a Green New Deal act, in terms of providing significant capital to fund new projects. And I'm not, and I want to be clear, with new technologies, you sometimes need to start out with projects that don't work economically, and they do need to get funded, and government can play an important role. And so I think that if you have a Trump administration, you're going to see the IRA get clawed back. Certainly that's what I understand will happen, but I think that the Harris administration would be much more favorable to more of supporting those sorts of things.
Got it. Okay. Thank you, Tyson. I'm going to turn back to Neil on the subject of politics here. There's been a lot of ink spilled on the differing tax regimes under a Trump or a Harris presidency. Most importantly, the corporate tax rate could be going from 21 down to 15 under Trump. It could be going from 21 up to 28 under Harris. Also under Harris, the capital gains tax rate could be going from 20% to as high as 33%. How does that affect the tax credits and the business that you're in? What do you see differing between a Trump and a Harris presidency?
Well, that's not a small question, Ed. Thank you for that one. Look, I think one of the ironies about the utterances that Trump has made on the Inflation Reduction Act, there are a couple. First of all, I think Elon Musk is hedging the EV credits by aligning himself with the Trump ticket. He wants to make sure they keep flowing. And I think if Trump is elected, he'll probably be successful in doing that. I think if Harris is elected, he won't have to worry about that. That'll be just fine. But the other irony is that the majority of benefits from the Inflation Reduction Act so far have flowed to red states rather than blue states. So Texas has had about 3 times the amount of benefit from the Inflation Reduction Act. And that's going to be tough to prize away from the politicians in those states, right? You would have a hard time convincing the Senate and the House to withdraw the kind of benefits that their electorate is getting in those states. I think that's sort of on the political side. As a purely mechanical thing, if you reduce the tax rate, you reduce the benefit of avoiding the tax, clearly, right? So the tax benefit of a tax credit is the same in dollar terms, but the incentive to use them becomes reduced. And that's particularly the case with things such as depreciation. So I think when you move up tax rates, the incentive to avoid those taxes increases. So it's actually been, higher tax rates have been historically a real shot in the arm to the tax incentive businesses. And so those are some of the sort of mechanical aspects of that. I think neither of the candidates is really super focused on what concerns me the most, other than the debt mountain that David was talking about earlier, is the fragility of the grid that we live on and that we all depend upon. And the more intermittent resources that you add to that grid, the more difficult it becomes to run that grid. So that's why I'm agnostic as to who's earning the tax credits, and I'll help anybody who is developing projects to place those credits. But I would love to see much more incentives taking place in nuclear. I think what's happened in Georgia is great, but it took too long with the most recently energized nuclear plant down there. So I think baseload power in the form of nuclear is incredibly valuable, and I would love to see more and more focus on that. I'm just not sure where investors sit on that. Historically, it's been a tough road to follow, but I think the impetus behind that is increasing, and that's a positive thing.
Got it. Okay.
Can I interject on that?
Yeah,
Bill Gates,
go ahead.
Bill Gates actually just funded a interesting nuclear project. I believe it's in Montana, where they're actually taking over an old coal plant. And what you can do is you already have the distribution infrastructure, and I think he's just putting in an SMR there. And I think that that's very much the great promise going forward. And it's something that I'd heard of and thought about, but I don't have Bill Gates resources. So when I saw that, I'm like, damn, But I completely agree. I think that nuclear has enormous potential, and I'd like to see more transactions like that. Perhaps other people not as wealthy as Bill Gates can benefit from them too.
Okay, thank you, Tyson. We have a question on nuclear in the audience.
Isn't nuclear really a domain that made the European use that much more effectively than the regulatory regime of the United States?
So the question is, isn't nuclear really more the domain of European countries who have a different regime that is more effective
I'm happy to
with
take that
nuclear?
if you want, Ed.
Sure.
So France has done an amazing job on nuclear. Germany, a terrible job. I think the deal that Angela Merkel struck to stay in power was with the Greens. And now, you have absurdities such as Germany pulling down wind farms to expand lignite coal plants, which is nuts, right? I think the issue that we have in the US with nuclear is cost. It costs us about 4 to 5 times as much to build a nuclear plant as it does in China, which is expanding nuclear at a faster rate than pretty much any other country. So we have a cost issue. And the regulatory regime is a huge part of why the cost is so high. The Nuclear Regulatory Agency has been the nuclear, obstacle regulatory agency, and it's done as a huge disservice. So I would agree with that.
Okay. Another question, Marty?
So, let's say that you were betting on this thing and by some wild chance Trump won. What's the play on deregulation? And also, I mean, I think it's common in this group, whether it's Trump or Kamala Harris, that need for infrastructure. Is there a play on infrastructure, and where do you play? I mean, I know Tyson's doing MLBs, so deregulation and infrastructure, maybe.
Okay, so did everyone hear the question?
You can repeat it.
Okay, question is, Trump versus Harris. Trump plans to do some major deregulation. And also Trump has plans around infrastructure. What are your thoughts on Trump versus Harris?
I'm not saying what's your thoughts. I'm saying what's the play? What's the alpha strategy?
What is the alpha strategy based on a Trump win that would promote deregulation and more infrastructure?
Well, infrastructure, either one.
I mean, there are a lot of funds out there that are raising money for infrastructure, period, right? Infrastructure is a longer term bet. It's not if Trump wins, if Harris wins, infrastructure, be it power lines, be it power plants, be it any of the highways, whatever you want to think of, are 5 and 10 year plans, right? So there are a lot of companies out there that are raising money for infrastructure funds. How efficient they're going to be as far as generating return and a significant alpha for investors, that I'm unsure about. But I don't think it matters who wins, because everybody knows we need to improve our infrastructure in this country and in vast parts of the world.
Infrastructure and energy.
Well, I'm talking about the same thing.
Yeah.
Can we pick up on Walker's comment, which is the very fact that many of the developed countries around the world are tapped out. They can't fund infrastructure. So the private side.
Well, that's where I was talking.
The question is, aside from KKR, Macquarie, BlackRock, who are the other alpha generators?
And what does it look like, right?
And who are the second tier players that are going to be there?
Right,
That's
right,
what-
right. So I'm asking, is there like a debt tranche? Is there
Who's
somewhere
doing it
in
right?
there in the
Who's doing it
stack?
right over the next cycle? Where's the money at? Question. Make sense, Jess?
Look, I couldn't give you the names of honestly what the funds are, but yes, there are multiple funds out there. Yes, KKR and Macquarie are obviously the two biggest. They've been doing it probably longer than most. So look, you can certainly stick with them because they're going to continue to do it. They've got the expertise to do it. But there are always going to be smaller mid-tier players that are going to get into the space because they're not stupid.
Marty, I think you're, if you're looking for an edge, I think companies that are supplying the construction and expansion of the electricity grid are great investments. Great investments. And I think from a deregulation point of view, look, I mean, I think both candidates rely on low information voters, right, who are not digging below the surface of the personality contest. But I think the the recent decision, the Supreme Court decision in Chevron, which is to move away from the regulatory agencies, some of the decision-making, is a good thing. I mean, I think the jury's still out as to whether that just hands powers to the law firms and whether the courts are sufficiently staffed to make those decisions, or whether Congress can actually take the responsibility to get things done. But I think moving things out of the hands of the EPA to the degrees that it has been participating in the past is a good thing, right? I think that's a good thing because we need our energy supply economy to grow, and we need our grid to grow.
Okay. Tyson, do you have a perspective on what Neil was just talking about?
Yeah, well, I think that one of the big issues in terms of energy is that there is all these licensing, permitting issues. There's called deep state. There's so much regulation. All these projects are a pain in the ass, whether they're nuclear or whether they're pipelines. And I certainly am hopeful that if there is a Republican administration, we will see that reduced. But I think that I can't think of a more compelling example of a lot of waste that occurs due to a lack of efficiency, and efficiency through reduced regulation, I think would be wonderful. How that comes to be, I don't know. Palantir, is certainly thrown around as a company that leverages its work with the government and was just added to the S&P. But there is a monstrous bureaucracy which just holds things up. And I would venture to say, from an economic standpoint, I think that people do not appreciate how important the price of energy is to inflation. And I believe wholly that if we are able to drill, that you will really meaningfully reduce inflation. But I watch what's happening in terms of lawsuits all the time, trying to get pipelines approved, and it just takes forever. I mean, it's glacial. But with regard to Alpha, I think if Trump wins, I think you want to buy all the MLPs and the energy companies, and I think that they could do very, very well.
Okay, thank you, Tyson. We've had a question on the end for quite a while.
Yeah, so sort of building on this, one of the, however, traditionally, willing to take that risk, and infrastructure players are not paying the returns, demand for the technology. How do you think the markets approaches this new technology, infrastructure, and also this other risk we talked about, risk of government, and also other kind of stuff, with the types of returns that work with infrastructure?
So the question is, new infrastructure requires new technology. Traditional investors in infrastructure have not been typically asked to make those heavy investments in technology. How do you bridge the gap between the current investor base and the projects that need to get built?
I don't know if you're going to get, I don't know if infrastructure really lends itself to getting high returns the way, I'll just say, a private software might, right? It's long-term, because to put any shovel in the ground, I don't care if you're building a house, if you're building a factory, you're building a pipeline, it takes months and years. Forget the regulatory, forget any of that for a second. It just takes so long. So your investment, your time frame for getting a return on your investment is going to be 5 to 10 years at a minimum, whereas other investments are going to be, maybe it's 5 to 10 months or 2 years or 3 years. So I think if you're going to be an infrastructure, look, I think there's great opportunity in infrastructure, but you have to really look at it as definitely a 10-year investment, not a 10-month investment.
Peter, are you saying that your investment horizon is shorter term?
No, but I think you have to understand that infrastructure, in my opinion, is longer term period, and probably not quite the alpha that one might expect.
I want to just jump in with that and add that part of the reason that you don't get the same alpha is because it's, and I'm hesitant to use the word guaranteed, but if you're investing in infrastructure, you're almost guaranteed investment because we will have roads, we will have railroads, bridges will be built, and so your return's going to go down as a result of that sort of quote guaranteed return on investment.
My point is that a lot of infrastructure now is technology based and the technology may or may not work. So if you're investing in, whatever, EVs, that.
So the question is that inherently a lot of these new investments in infrastructure are betting on technologies that may or may not work. We'll have, some technology that will end up being the solution. Meanwhile, losses will be made on investors, by investors, if we stick with the same investor base that make bets on what technology will win. Does anyone have comment on that? Right.
You have to address this problem the way you would any corporate problem. You have to address it on a strategic basis. Right now, we do not have a business model that works. It's sporadic. What is the business model that could be created that's strategic, that enables this to occur? Because if you have another 20% inflation in the next 3 years, this country's finished. How are you going to deal with 40% inflation? So there has to be a strategic business plan. What is that? What do you recommend? What are your ideas on that subject?
We're not trying to be holistic here. We're just trying to alpha.
So,
I mean, the house is burning, but.
so there's one example that I think is worth noting. There's a company, I think it's called TS Conductor, whose business model is to increase the efficiency of transmission lines that are already in place. That company is getting some significant funding, right? It's an example of an ingenious technology that the private market is ready to fund, right? So that's a great example of something that may work. What Tyson said about the SMR, the Gates is investing in the site of an old coal facility is also a great example. There's a technology out there called fugitive methane capture, which is taking the methane that's leaking out of coal facilities and sequestering that. And there are tax credits that are available to do that are incentivizing that particular business model. So there's definitely a role for some incentives for the government to sort of operate a little bit of industrial policy. But I think it's sort of what Tyson said earlier, drill, drill, drill. I think that's great. We've produced as much, more than anybody else in the world as an economy in terms of oil and gas during the last administration, ironically. And the more you drill, the more that you produce, the price goes down. That disincentivizes more drilling and production because the price is lower. So there's a constant sort of push-pull between the $70 and $90 oil. Or is it rolling over? Those things, there's a role for price discovery through the private market, somewhat incentivized by the government. But there are some great technology stories like TS to be found if you go looking for them.
I still think if you create a strategic business plan, it will create alpha. Those are the offshoots. If you create a strategic business plan to solve this problem, you have to have alternatives to develop the alpha incentive. There has to be that. Otherwise, it won't function.
So-
Yeah. I'm with Iceberg Capital. We're a $40 billion AUM infrastructure fund manager. We've been raising separate pools of capital to focus on the tech. So it's higher risk, higher return, focus on technology, serving disruption.
Okay.
Different investor groups, but then once those technologies mature, how do we invest out of the flagship infrastructure?
So the comments from an audience member who invests in infra tech is how it's known. What's the name of the fund that you're at again? I Squared Capital, big player in infra tech with 40 billion under management.
Can I say one thing that's like, it's called rewiring, and basically there are much more efficient wires. It's not even like the newest, like future tech, it's today tech. And you can replace wires with wires that transmit much more exactly the same.
Okay, so the comment is that rewiring is often very efficient and it exists now and people are doing it. Okay, we're going to turn back to politics. Peter, Elliot, Trump versus Harris, does that affect any of the strategies that you're managing for your clients?
I don't think so, no.
Elliot?
No.
Okay. All right, so I'm going to open. How does it impact credit strategies? The full panel here.
I mean, credit strategy will be impacted by interest rates more than anything else, obviously. So I think we all probably agree in this room that rates are going to be coming down over the next 3 to 6 to 12 to 18 months. So that, might change the margins a little bit, but I don't think it has a drastic impact on the strategy itself.
Okay. I'm going to have some questions. Tyson?
I'm sorry, is that a question?
The question is Trump versus Harris. How does that affect credit strategies?
I would think credit strategies would do better if Trump wins.
Okay, thank you. I'm going to ask some questions that anyone can answer or not. How do you see the alternatives industry evolving going forward? Continued rise of privates? Will there be a hiccup there? Do you see increasing numbers of high net worth investors impacting demand for certain alpha strategies? And do you see mandate changes for managers given these preferences? All right, so open for the whole panel.
Well, I think one of the things that is maybe not obvious on the face of it, but more tax is paid through pass-through entities now than by corporations. So in other words, tax ending up on 1040s as opposed to through an 1120 corporate tax return, which means that I think the private investment community is due to start benefiting from some of the government incentives available. And, it's challenging because you have to have passive income and you have to figure out what that is. Quick call to your accountant will help you figure that out. But I think you're going to see some increasing sophistication brought in to the, to the family office community in terms of getting involved in some of the energy projects that are available. And I think that's a great thing. So, do you call that debt or equity? I think, there's going to be a sort of a hybrid type. I think there's going to be more preferred investments that have a stated, a stated yield, but are benefiting on a sort of 5 to 7 year event to get that return. I think so hybrid strategies which are able to benefit from some of the tax incentives, but have something of a more predictable return is going to be a perfect entry point for some of these investors. I don't know, honestly, whether I think that's somewhat disconnected from the administration, whether it's Democrat or Republican. My biggest concern is that the greater that the debt grows, the more it begins to crowd out private investment, because we're sort of in this weird phase of fiscal dominance where eventually, the Treasury and the Fed are going to start massively incentivizing the private sector to start buying some government debt because there are fewer and fewer players who are interested in buying that overseas particularly. So that does worry me. And neither candidate, honestly, is doing anything to reduce the debt mountain, because it's not politically popular to talk to people about increasing the retirement age, privatizing Social Security, cutting back some of the benefits that they're getting in sort of later years. So that's the thing that concerns me as to whether the crowding out is going to, act as a brake on the private economy.
Got it. Okay. Thank you, Neil. Anyone else on how the alternatives industry will be changing over the coming years? Focusing on how the investor base is changing, perhaps focused on the continued rise of privates. Anyone?
I mean, I think it'll continue to grow because I think the bigger players are continuing to go down market to find more investors, to find smaller investors. Obviously a lot of people are qualified purchasers, but they're developing funds to attract smaller investors. And I think we've seen that over the last 5 or 10 years, and it's going to continue over the next 5 or 10 years. So it's going to grow.
Got it. Okay. Thank you. Elliot, Tyson? No? Okay. We got a question from Marty.
Any thoughts on the impact of AI and quantum computing on alpha strategies?
So the question is the impact of AI and computing on alpha strategies.
Move over single stock managers, and I think AI who are using a high level of qualitative analysis. I think it's going to have a phenomenal impact on a going forward basis. And I think the business models of investment management today, from an operating structure, technology standpoint, an investment process, are going to look radically different in 10 years. And that, and it's starting to take shape today. But I think qualitative analysis is, and I don't want to say that's going to be removed, but I think we are going to move more and more into structured data type analysis. I think AI is going to revolutionize the investment management business like the internet did to retail and commerce.
Wow.
And frankly, large managers who are actually any size manager who is not embracing that is going to be left behind. And just as an example, Sears Roebuck was the ideal business. They were the gold standard of retailing. This is what capitalism looks like, and it is there will be a ferocious swing in change in operating models and investment process. And I think
Okay. Sorry, Marty asked, can you describe more the qualitative process that will be going away and edged out by a more quantitative process driven by AI?
Yeah, great question. So personally, I really enjoy reading 10Qs and 10Ks. I mean, if you wanted to, it's just something I really, from the first page to the end. I also enjoy reading earnings transcripts. I never listen to them because I don't want to be influenced by the intonation of the speakers, but I love reading them. That is and when historically I've made investment decisions, there was a qualitative analysis that was a part of that as a result of reading the Qs and the Ks. Here at Global Return, we've converted all of that into structured data and an algorithmic process for analyzing that data. So that's one example. Historically, I've really enjoyed walking manufacturing facilities of companies that we own stock in. That is going away.
Okay.
So those are
Thank
two
you, Elliot.
examples.
Family offices have different, very variable between family office to family office, return objectives, risk objectives, timeline objectives. especially when you compare them to an investor like an endowment or a pension that are much more homogeneous. How have you addressed these differences in your business? Different products offered, different share classes, otherwise different investment processes. It's open to the entire panel.
I mean, we're kind of bespoke with our clients. So, we don't necessarily, we're not a fund manager, so we don't have different share classes, right? It's not a world that I play in per se of structuring a share class. We're always trying to find the lowest cost for our clients. That's what matters, in whatever share class we're purchasing. But, we're bespoke in how we treat each of our clients because every client's there are nuances that are a little different. I would say two people can walk into my office that are both, 50 years old. They both make $1 million. They both blah, blah, look very similar. But when you get to know them, they're actually very different. And so the solution that worked for one, you would think, oh, well, it must work for every 50-year-old that walks in the office that makes $1 million. It doesn't because there are a myriad of differences in goals, objectives, family structure. The list is almost endless.
Okay, thank you, Peter. Anyone else on that question? No, okay. I think we have a few minutes left. We can open it up to more audience questions.
I have another question.
Yep.
So, I was hoping that Elliot could expand on, who might be emerging players and where do the old standard bearers in the space, where were they, what happened to them? Large banks, or other large funds, asset management, et cetera. Maybe give some perspective, conjecture, whatever. Tyson, everybody else can join in as well, but so let's start with Elliot.
Okay, so not sure everyone heard the question. The question is from Marty directed to Elliot, but open to the rest of the panel afterwards. Expand more on how you see the alternatives business changing over time, and with respect to the players in the alternatives business. So the banks. Are there opportunities for new players, for VCs? Will the old players, what types of old players will go away, be it private banks, hedge funds, other fund of funds, whatever type of entity type you can think of?
Yeah, so great question. I think in terms of, so I'll speak from my perspective. First of all, we are an emerging player, and I would welcome the opportunity to speak with anybody about our tech stack and what we're doing, because it is truly different and unique. Again, we don't use any off-the-shelf software, and our results are in the top decile. I think any alternative asset management company that is not embracing technology as their number one priority is in trouble. And we can look at every single industry, actually, except for maybe the infrastructure industry, that has gone through since 1900, that has been continually replaced because of innovation. And the asset managers of yesterday, who may not have an operating infrastructure to integrate new technologies, are in a lot of trouble. I mean, I'll give you an example. A lot of today's asset managers have their entire business built on certain legacy players, legacy data resellers, and are operating on Excel, and are operating on Excel. And those technologies are just not as efficient. They're not as accurate. And the product pipeline coming through those systems are not built for tomorrow. At Global Return, for example, we have an incredibly nimble operating infrastructure, which allows us to quickly adjust. The same is true with our algorithm. Yeah, I don't know if I accurately answered the question, but I do think a lot of legacy alternative asset managers who are using uh, a bottom-up fundamental process might be at risk.
Okay.
Now,
Thank
when I
you,
say
Elliot.
bottom-up fundamental process, I don't mean that they're going to not look at fundamentals, because we also look at fundamentals. But the days of downloading Excel spreadsheets from Bloomberg, those guys are gone.
Okay, thank you. Any more questions here? Oh, I think that was a pretty good panel. Thank you all. Thank you very much.